Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Hostess brands and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Hostess Brands was founded in 1919 and develops, manufactures, markets, sells, and distributes snack products in North America. Products include pastries, cookies, and sweet baked goods sold under brands such as Hostess, Dolly Madison, Cupcakes, Twinkies, Snowballs, Ding Dongs, and Ho-Hos. Hostess Brands has generated a lot of interest recently as it has been reported that the company is seeking to be acquired. For current shareholders, this could mean a nice profit as seen by the recent 25% pop in share price. Now, let's see if the share price is worth the hype. Starting with the 1-year chart, we see that Hostess Brands had a CAGR of about 20%. Zooming out to the 5-year chart, we see that Hostess Brands had a CAGR of 19%. The share price has steadily grown over time. This is a very nice chart. Now, let's take a look at the fundamentals. Gross margin is 35%. This is surprisingly high for a packaged foods company, but brand value matters. Revenue has compounded at around 11% over the past 5 years and has reached nearly $1.4 billion most recently. Great gross margins and good revenue growth make this company look sweet. Looking at cash flow, we see a 13% CAGR in cash from operations over the last 5 years, while capex has increased at a CAGR of 29%. This results in a slowly growing free cash flow with a 3% CAGR. Capex is growing at more than double the pace of cash from operations. If this trend continues, then capex will outweigh cash from operations at some point, resulting in 0% free cash flow growth. Weighted average shares outstanding have been increasing at about a 6% CAGR, going from 103 million shares in 2018 to 136 million shares most recently. Hostess Brands has been slowly diluting shareholders over time. However, this dilution peaked in 2021, which may represent an opportune time to take advantage of the reversal trend. Now let's view return on invested capital. Return on invested capital has increased from 4.3% in 2018 to 5.7% in 2023. While the current value is not high, the improving trend line is promising. This is what we want to see. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 31 days in 2018 to 39 days most recently, Hostess Brands has gotten comparatively less efficient managing inventory. This is not ideal. Last, let's explore Hostess Brands debt. The net debt to EBITDA is 2.9, down from 5 in 2018. This means that Hostess Brands has been very diligent about paying down debt over time. While a net debt to EBITDA of 2.9 is not super low, the trend downwards is very promising. The fundamentals of Hostess Brands are decent, though the dilution seems to be an issue. But is it good enough to be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Hostess Brands. It is a food company with a gross margin of 35%. The 5-year revenue per share CAGR is 4% and the 5-year free cash flow per share CAGR is -3%. A return on invested capital of 6% is pretty low but is uptrending. Next, the cash conversion cycle of 39 days means that it takes Hostess Brands over 1 month to get paid from their products after paying their suppliers. This is not what we want to see. Concerning debt, a net debt to EBITDA of 2.9 means that Hostess Brands could pay off all of their debts with almost 3 years of earnings. So from a fundamental standpoint, Hostess Brands is largely a decent business, but the shareholder dilution is punishing per share metrics. Now let's switch our attention over to valuation. Hostess Brands is slightly undervalued relative to the S&P 500 with a ratio of 0.9. The price to earnings growth, or PEG ratio, is 2.5, which means that Hostess Brands is overvalued compared to its projected earnings growth. Hostess Brands has had many recognizable brands in its portfolio for many years. Great gross margins, growing revenue, increasing free cash flows, and improving return on invested capital are all positives. How shareholder dilution is diluting otherwise good fundamentals. Several food companies seem to be in an investment cycle where they are increasing capex. Theoretically, this capex spend is an investment in the business, but it is unclear how long investors must wait for this capital investment to bear returns. However, the reversal of the growing share count does catch my interest, but I will watch for more improvement in the fundamentals. It is a pass for now, but I will place it on the watch list for closer monitoring. Many thanks for watching. What do you think about Hostess Brands and its rising capex spend? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.